Welcome to The Explainer. Today, we're diving into the exciting and sometimes pretty turbulent world of wealth creation. We're going to explore a super fascinating case study on the Motilal Oswal Midcap Fund. Whether you're a seasoned investor or you're just starting to figure out where to park your capital for the future, understanding exactly how a high-profile fund navigates both booming markets and sudden downturns is just an incredible way to sharpen your own financial toolkit. We're going to look at real data, real performance, and real risk metrics.
Here's our roadmap for today. 1. What are midcap funds? 2. Motilal Oswal historical performance. 3. Analyzing recent market volatility. 4. Key risk metrics for beginners. And 5. Comparing peers and benchmarks.
Section 1. What are midcap funds?
So, by definition, midcap funds invest predominantly in companies ranked between 101 and 250 by size. Mutual funds in this category are actually mandated to invest at least 65% of their portfolios in these mid-sized companies. What you're really buying into here is the potential to own the market leaders of tomorrow. These companies have the flexibility, the creativity, and honestly the room to rapidly increase their market share. But because they're still growing and scaling up, this strategy absolutely requires a patient investment horizon of at least 5 to 10 years. You really have to be prepared to stay invested through the market cycles.
Think of it kind of like a theme park ride. Small caps, they're the absolute wildest roller coaster in the park. They offer explosive growth, sure, but with extremely high volatility. Large caps, on the other hand, are like the slow, steady Ferris wheel. Mid caps sit right in that sweet spot. They offer that same thrilling high-growth potential of a small cap, but with a slightly smoother, more established track, because their business models are already proven out. It's balanced growth with moderate risk. Section 2. Motilal Oswal historical performance. Since kicking off in February 2014, Motilal Oswal's core strategy has been all about a high-conviction approach. So what does that actually mean for us? Well, while a lot of pure funds might hold anywhere from 60 to 90 stocks to play it safe, Motilal Oswal places highly concentrated bets on just around 19 to 30 quality mid-cap companies. They aren't spreading their capital thinly across the whole market. They're picking their absolute best ideas and backing them heavily. And man, the payoff for that strategy has been something to see. Historically, the fund shows a massive 5-year compound annual growth rate of over 23.83% and a 3-year return of 21.27%. That stellar performance helped their assets under management balloon from roughly 1,800 crore in 2020 to over 37,000 crore today. During prolonged bull markets, this concentrated, conviction-driven strategy worked exceptionally well. Section 3. Analyzing recent market volatility. But as any seasoned investor knows, market leadership is rarely a permanent thing. We have to look at this impartially and ask, how does a fund go from being the king of the 5-year return chart to suddenly delivering a 1-year return of just 4.93%, actually trailing behind its benchmark? Taking a look under the hood reveals exactly what happened with this underperformance. First off, the fund manager was holding cash at the start of the year, anticipating that market valuations would drop. When the market did correct, they deployed that cash, but the market didn't bounce back the way they expected. Combine that cash drag with their heavy, concentrated bets in financials at 31% and technology at nearly 27%, which are sectors that have recently been in a downtrend, and you can see exactly what severely dragged down their recent performance. Basically, when you place heavy bets and the trend reverses, the impact on your portfolio is magnified. Section 4. Key risk metrics for beginners. Okay, let's build up your analytical toolkit. Now, don't worry, these aren't complex mathematical hurdles designed to confuse you. They're really just the vital signs of a fund's health. We're going to look at standard deviation, which measures the bumpy ride, beta, which shows how the fund moves relative to the overall market, and alpha, which tells us the actual value the fund manager is adding. First up, standard deviation. For the Motilal Oswal Midcap Fund, this is sitting up at 20.48%. To put that into perspective, the category average for midcap funds is only around 17.69%. So objectively speaking, this tells us that this fund's returns fluctuate way more widely than its peers. It puts this fund firmly in the front car of our roller coaster. It's a highly volatile ride. Next, let's check out beta. A beta of 1 means a fund moves exactly in sync with the market. Motilal's beta hovers right around 0.95. This is actually pretty fascinating because it means that despite its high internal volatility and all those concentrated bets, the fund as a whole moves just slightly less drastically than the broader market benchmark. And then we have alpha, which, let's be honest, is what you're really paying a fund manager to generate. Here, we see a positive 2.60%. That tells us that over a 3-year period, even with the recent 1-year slump, the fund manager is still successfully adding significant value above what the market naturally provides for the level of risk taken. But there's another vital sign we really need to check, and that's portfolio turnover. Motilal has a very high portfolio turnover ranging from 84 to 135%. For conservative investors, the crucial takeaway here is that this high turnover means frequent stock swapping. Instead of a stable, long-term buy-and-hold strategy, the managers are actively trading. And during a market correction, this constant adjustment can actually inject more instability into the portfolio rather than protecting it. Section 5. Comparing peers and benchmarks. Now, this is where things get really interesting, seeing how different strategies play out over different timeframes. Take a look at HDFC and Edelweiss. They have much lower volatility, meaning a lower standard deviation, and they rely on a wider, more diversified basket of stocks. Because of that, they offered much better 1-year returns during the recent market correction, both sitting right around 13.5%. Yet, if you look at the 5-year column, Motilal still remains the undisputed king of the long game, with nearly 24%. It's a classic trade-off between short-term stability and long-term aggressive growth. And when we contrast it against the Nifty Midcap 150 benchmark index itself, the story stays totally consistent. Over a 10-year cycle, Motilal absolutely proves it can beat the index, delivering an 18.83% CAGR compared to the benchmark's 17.90%. But you have to look at that standard deviation. To get that extra return, the fund demands that you stomach a significantly bumpier ride, a volatility of 20.48% versus the index's 15.21%. So you might be wondering, why would an investor still choose this fund given the recent 1-year lag? Well, ultimately, it holds some distinct advantages over riskier small-cap alternatives. It gives you a proven, high-conviction growth engine that can aggressively capture the upside during bull markets. Plus, the promoters have massive investments in it themselves. A staggering 17.7 billion rupees of their own money is invested in the fund. That is a crystal-clear display of skin in the game, signaling a really strong internal belief in a long-term rebound. As we wrap up this explainer, I want to leave you with this to think about. Armed with all these risk metrics, what kind of ride truly fits your personal investment horizon? Are you looking for the steady, diversified safety of a broader fund? Or do you have the patience and the stomach to ride the high-conviction roller coaster for potentially market-beating long-term gains? The choice and the strategy is entirely yours. Thanks so much for joining me on The Explainer, and keep learning.